Hello and welcome to Gemini Traders Update, your trusted source for market intelligence and tactical investment strategies. I am Zain, and today we are delving into our comprehensive macroeconomic and investment strategy report for February 2025. In this episode, we'll break down key trends from trade wars and inflation to AI growth, cryptocurrency developments, and geopolitical uncertainty and explain precisely how these forces impact your portfolio. Let's get started. Okay, so our report establishes a transparent, adaptive, and data driven framework to navigate today's volatile markets. By leveraging advanced Monte Carlo simulations alongside deep fundamental and technical analysis, we identify the key market drivers. Consider this: AI remains a powerful growth engine, yet near-term valuations suggest a potential correction. Meanwhile, Bitcoin's long-term adoption is strong, though its short-term speculative pressure requires tactical caution. Finally, trade wars are reshaping supply chains in ways that impact almost every asset class. So always monitor these core drivers and adjust your positions as new data becomes available. Subscribe for real-time updates to stay ahead. Now let's shift focus to geopolitical landscape. Although the headlines might highlight US-Russia peace talks, the reality is more nuanced. Europe is ramping up its defense spending, and China is repositioning amid shifting US-EU relations. This scenario suggests that defense stocks like Lockheed Martin (RTX) may see increase in demand, while European firms such as Airbus could benefit in the long run. On the trade war front, the 25% tariffs are not just about inflation, they are prompting companies to move production from China to emerging markets like Mexico, India, and Vietnam. This transition places pressure on margins in sectors from agriculture to semiconductors, while giving domestic manufacturers an edge. So consider overweighting defense sectors and keeping an eye on domestic manufacturing and emerging market ETFs. Adjust your exposure as these supply chain realignments continue. So inflation today is, as we all know, it's not uniform. It varies greatly by sector to sector, industry to industry. Here's what our analysis shows. Regarding shelter inflation, it is up 5.8% every year from year due to persistent housing shortages and high mortgage rates, supporting strong rental demand. When we talk about service inflation, we are holding at about 4.9% due to sustained post-pandemic activity, which bodes well for defensive areas like healthcare and travel. Regarding goods inflation, in a deflationary state at minus 1.2% as supply chains stabilize, creating potential buying opportunities. For energy at 1.8%, it remains volatile, impacting profit margins, especially in consumer-driven industries. For food, moderates at 3.2%, anchoring overall price stability. So what we're trying to do is we should just hedge against the inflation, as it surprises initially with gold and bonds. For the medium to long term, observe wage pressures. If there is faster than expected, consider rotating into a higher beta growth assets. So when we talk about the Monte Carlo simulations and scenario, our strategy is underpinned by a rigorous Monte Carlo simulation, 10,000 iteration to model key economic factors. Let's break down some critical inputs. Now, US GDP growth in 2025, the baseline at 1.7%, with potential scenarios from 0.8% to 2.2%. Lower growth may slow economic momentum, while high growth could trigger more aggressive Fed actions. CPI inflation in the quarter four or 2025 set at 3.1% on average. Those scenarios range from 2.6% to 3.7%. Persistently high inflation might delay rate cuts and push bond yields upwards. Fed rate path model at a baseline of 4.75%, but could vary from 3.5 to 5.5%. A higher rate impacts tech valuations, low rates offer growth potential. Further, our model incorporates AI revenue growth, 22% CAGR for industry leaders, and Bitcoin sensitivity to ETF inflows, with unified probabilities indicating a 53% chance of prolonged inflation above 3.5%, a 35% chance of an AI correction for tech stocks, approximately 31% odds of a Bitcoin correction due to leverage risks. So you got to use these probabilities to flexibly adjust your portfolio. Regularly reassess your market positions as market evolves. So now, what we also need to talk about is portfolio correlation and risk dynamics. Understanding the interplay between different assets is very essential. So our recent analysis shows the Nasdaq 100 and Bitcoin have a high correction of 0.72%, indicating that when markets are risk on, they often move together. Gold with an inverse correlation of negative 0.45% to Nasdaq 100 continues to be a reliable hedge against equity risk. You know what I mean? However, Bitcoin and gold display a weak correlation, 0.11, suggesting that they serve very different roles in risk management. So don't rely solely on one asset class for hedging. Diversify by including defensive equities such as consumer staples and utilities, along with safe haven assets to create a balanced portfolio. Let's examine now our views on Bitcoin and Nasdaq. For Bitcoin, our threefold approach encompasses on-chain insights, ETF low market impact, and historical bubble comparisons. Here's our target price range for Bitcoin. So the base case is 100K to $110,000. The bull case up to $125,000 if network adoption accelerates. And if you're looking for a bear case, around $85,000 if leverage pressures results in rapid corrections. Now to the Nasdaq. Key technical signals are bearish MCAD crossovers and RSI over 75, rising put call ratios indicate that a short position might capture a forthcoming correction. Our disciplined stop loss of around 10% is designed to protect against sudden market reversals. So consider a short on tech-heavy Nasdaq positions while being meticulous about stop loss orders to manage risk. And when we talk about the final trade execute plan and risk management, here's our final execution plan for your portfolio for your portfolio adjustments on how you should look for these different asset classes if you're looking to execute trades. Again, this is not a financial advice. This is just how we interpret the market. So, and we are talking about taking some long-term positions, which means our position size will be smaller than a scalp position, as we are looking for bigger targets. So for gold, we are looking to make an entry at around $2,900 and $2,950, $2,950 from $2,900 to $2,950. Our target price will be $3,050 to $3,100, and the stop loss order are going to be about $2,850, 2850, and so it's It's proven as a hedge during periods of inflation and geopolitical uncertainty. For Bitcoin, the entry we are looking to make will be around 90,000 to $95,000, and we will be buying on the dips. The target will be 110 to 115K, and the stop loss will be about 85Ks. And for Nasdaq, the entry will be around, and we are talking about the quarter-to-quarter ETFs. So for the ETFs, we're talking about $400 to $410. The target will be 375 to 380, and the stop loss will be a small stop loss will be about at 420. So overextended tech valuations and AI sector correction justify this short position. For Microsoft, we're looking to make an entry at 400 between 400 and 410. The target would be for 460 to $480. The stop loss will be $385. It is driven by robust AI cloud revenue growth and historical tech performance. Now, these levels are based on both historical analogs and current risk parameters. Regularly adjust stop loss orders aiming for 10 to 25% buffer to protect against market volatility and review your portfolio as macro conditions shift. So, this is my final verdict and this risk disclosure. In conclusion, our refined strategy for February 2025 offers a robust data-driven approach that combines deep macroeconomic analysis, advanced Monte Carlo simulations, and precise technical insights. Whether you are evaluating AI valuations, managing Bitcoin's dynamic risk profile, or navigating global trade shifts, the key is to remain adaptive and informed. Now, what you need to understand is trading involves significant risks, including the potential loss of principal. Past performance is not indicative of future results. Always consult with a licensed financial advisor before making investment decisions. Stay updated with evolving market conditions, fine tune your strategies according, and always use risk management tools like stop loss orders. Thank you for tuning into Gemini Traders Update. If you found this insight valuable, please subscribe, share, and check out our show notes for additional education resources and detailed risk disclosures. Stay informed, stay responsibly, and happy investing.